How would you feel if the Fed cut interest rates by 0.5% tomorrow? Would you be happy, worried, or indifferent? How would it affect your investments, your mortgage, your business, and your income? We'll explain what the latest economic data means for Fed rate cuts, markets, real estate, and so on. So stay tuned. The U.S. economy ended 2023 on a strong note, adding 216,000 jobs in December, beating expectations of 180,000. The unemployment rate remained unchanged at 3.9%, while the labor force participation rate edged up to 63.2%. The average hourly earnings rose by 0.4% month-over-month and 4.1% year-over-year, indicating solid wage growth. These numbers suggest that the U.S. labor market is still robust and resilient, despite the headwinds from the trade war, the global slowdown, and the political uncertainty. However, they also pose a challenge for the Federal Reserve, which has signaled a shift to a more dovish stance in 2024, after raising interest rates 4 times in 2023 to a range of 5.25%, The Fed's main dilemma is how to balance the risks of overheating the economy and causing inflation to rise above its 2% target versus the risks of underestimating the slowdown and causing a recession. The Fed's preferred measure of inflation, the Core Personal Consumption Expenditures, PCE price index, has eased over the past year, falling from 2.4% in November 2023 to 2.1% in November 2024. The Fed expects it to decline further to 2% in 2024 as the effects of the tariffs and the tight labor market fade. The Fed also faces the challenge of communicating its policy intentions to the markets, which have been volatile and sensitive to any hints of rate changes. The Fed's dot plot, which shows the projections of individual Fed officials for the future path of interest rates, indicates that the median Fed official expects 3 rate cuts in 2024, bringing the Fed funds rate down to 4.5%, 4.75%. However, the markets are pricing in 6 rate cuts, possibly a 7th, implying a much more pessimistic outlook for the economy. The Fed's chair, Jerome Powell, has tried to reassure the markets that the Fed will be patient, flexible, and data-dependent in its policy decisions, and that it will not overreact to any single piece of data. He has also emphasized that the Fed will take into account a wide range of factors, such as global economic conditions, financial market developments, and the fiscal policy outlook, in addition to the inflation and employment data. The Fed's next meeting is scheduled for January 29, 2024, and it will be the first one with the new voting members of the Federal Open Market Committee, FOMC, the Fed's policy-making body. The annual rotation of the FOMC means that 4 regional Fed presidents will join the voting group, replacing 4 others. The new voting members are slightly more hawkish than the outgoing ones, meaning that they are more inclined to favor higher interest rates to prevent inflation. However, this does not necessarily imply a change in the overall policy direction, as the Fed's leadership, Powell and the other board governors, have more influence and tend to be more moderate. The Fed's policy decisions in 2024 will have significant implications for the markets, the real estate sector, and the overall economy. The markets will closely watch the Fed's signals and actions and react accordingly. A more dovish Fed, which cuts rates more than expected, could boost the stock market as lower interest rates make equities more attractive relative to bonds. However, it could also weaken the U.S. dollar, as lower interest rates reduce the returns on dollar-denominated assets. A weaker dollar could benefit the U.S. exporters, as it makes their products more competitive abroad, but it could also hurt the U.S. consumers, as it makes imports more expensive. The real estate sector will also be affected by the Fed's policy moves, as interest rates affect the cost and availability of mortgages. A more dovish Fed, which lowers rates more than expected, could stimulate the housing market, as lower mortgage rates make home buying more affordable and attractive. However, it could also increase the risk of a housing bubble, as lower mortgage rates encourage more borrowing and speculation. The U.S. economy closed 2019 with a solid performance, adding 216,000 jobs in December, well above the consensus forecast of 160,000. The unemployment rate stayed at a 50-year low of 3.5%, while the labor force participation rate edged up slightly to 63.2%. The average hourly earnings increased by 0.4% month-over-month and 4.1% year-over-year, showing healthy wage growth. These numbers reflect a resilient and robust labor market, despite the headwinds from the trade war, the global slowdown, and the political uncertainty. The businesses will also be affected by the Fed's policy moves, as interest rates affect the cost and availability of credit. A more dovish Fed, which lowers rates more than expected, could stimulate business activity, as lower borrowing costs make investment and expansion more affordable and attractive. However, it could also increase the risk of over-leveraging, as lower borrowing costs encourage more debt and speculation. A more hawkish Fed, which raises rates more than expected, could dampen business activity, as higher borrowing costs make investment and expansion more expensive and less appealing. However, it could also prevent over-leveraging, as higher borrowing costs discourage excessive debt and speculation. According to Glassdoor, a platform for employees to anonymously leave reviews for their companies, employee sentiment has been picking up in the last 3 months of 2019 after declining for most of the year. The Glassdoor economic research team tracks employee sentiment using a proprietary index based on the overall rating and the 5 sub-ratings of the reviews: work-life balance, culture and values, career opportunities, compensation and benefits, and senior leadership. The index increased from 3.46 in September 2019 to 3.51 in December 2019, though it remained below the 3.54 level in December 2018. Glassdoor's lead economist, Daniel Xiao, says that employee sentiment reflects how businesses are doing financially, as well as other labor market indicators. He notes that while the jobs report was strong, there were some concerning data points, such as the labor force participation rate slipping for prime-age workers and the underemployment rate rising for workers with a college degree or higher. He also points out that employee sentiment varies by industry, with some sectors, such as healthcare and technology, showing higher satisfaction than others, such as retail and manufacturing. Will the Fed cut rates more than expected, or will it hold steady? How will that affect your financial situation and your plans? Let us know in the comments below and share your thoughts and opinions with us. Please give it a thumbs up and subscribe to our channel for more videos.